There's a time when I invite people over and we have an applause thing. How quickly can we get that? Because Savita is here. Savita is here. We did it. They did it quick. As Ralph may not be here to stay. Now I got to read this after I had it all ready to go. Anyway, trade tensions are rising. Our next guest says things are likely going to get worse before they get better. This is not different, Savita Subramanian, than what we've been hearing already from the traders. You're head of quantitative strategy at Bank of America Merrill Lynch, and welcome back.
Thank you. Yeah. Great to be here.
You see a disconnect between.
What's going on?
I've seen equity markets in the 10-year, and it just looks like maybe not everything is it has great underpinnings. But I don't know if that's true.
Well, it's interesting because I think what's driven the market higher or what's kept it at these levels isn't necessarily the cyclical stuff. It's the yieldy, quality, defensive stuff. So I think the stock market is singing right along with the bond market and saying, don't buy anything with any cyclical hair on it and just buy like utilities and, tobacco stocks. And I think that that's kind of what's going on internally with the market. I mean, I think if you look at what's happened so far, what was surprising is that we've seen, such a rapidity and such a kind of a heightening of the tensions. And, what's called into question now is whether we see a full-blown resolution kind of early into this year, or whether this extends into next year and turns into an election issue. And I think that the market's response is going to determine that. So if the market drops another 10%, we'll likely hear policymakers dial back the rhetoric a little bit, and we'll get to a better place. But I do think that there's something going on right now that is a little bit unnerving. I mean, if you look at oil prices, if you look at the slope of the yield curve, everything is telling you that we're heading into a recession. And I mean, the equity market is holding up better, but it's not necessarily the cyclical stuff that's pulling it higher.
It's just sub 4% unemployment. We'll see Friday. The ADP didn't help, but that number has been so off, now and again. I mean, it was 275. I think last month.
Right.
And that was validated by the real number that came out on Friday. This was an important number, I guess, on Friday. But you think that the psychology of, because the trade stuff has not filtered into any numbers yet,
economy.
but
no,
you think
right.
psychologically that could have caused corporate managers to pull back in a big way?
Oh, yeah. I mean, we're already seeing that. So I'll tell you one interesting data point. If you look at the companies that are guiding above versus below planned CapEx expectations, from January through April, these numbers were great. And everybody's like, we're going to spend a lot more than you think we're going to spend. And then in May, all of a sudden, we saw a big nosedive, especially in industrials companies, tech companies. So companies are already saying, I don't know what the world is going to look like next month or next year. So why would I start ramping up my, my factory building at this point?
So Savita, based upon that, how would you then judge the change in earnings revisions downward? So it seems to me you just put out a note where you've talked about you've downgraded a little bit.
Yeah, we took down our numbers. And let me tell you, so we took down our numbers simply on the direct impact of the tariffs. So this is basically, the extra prices that we're going to pay for Mexico and China stuff, as well as the potential hit to our exports. We're not factoring in anything indirect. And here, I think the missing link is that some of the indirect impacts could actually be positive for U.S. earnings, right? I mean, the whole point that we're doing these tariffs in the first place is to bring jobs back to the United States. And if that actually happens, that could be a huge spigot of growth that nobody is factoring into.
Aren't the labor markets too tight? I mean, are we running into job shortages?
That's why they said the ADP report was weak, because they couldn't find people.
Yeah, because you can't find people anymore. But I mean, look at automation. I mean, robotics is still a thing. We haven't fully automated everything. There's huge gains to be made there. I mean, I don't say this happens in the next 6 months, but I think there's a longer-term, potentially bullish theme that we're not necessarily factoring into any estimate.
They're saying goodbye, Mayor. I think they mean to you, right? You don't want me to leave.
I don't know why we do that.
Where you going?
I don't know. But
I mean, you got another 45 minutes.
Okay, no, it's Savita. It's not me. I'm staying. Savita, thank you. Are we heading into a recession, Guy?
I don't know the answer to that, but I'll say this. Why do we look at recessions and say it's such a bad thing? It's a natural part of the business cycle. I mean, it's not a terrible thing to go through a recession, right? I mean, it should be a natural part. should happen every few years or so. We talk about it like this horrible thing. I'll say this. In the Fed trying to stave off the recessions, they've made any downturn that much worse. They've made U.S. corporations in large part lazy because they don't have to focus on their business. They borrow cheap money, buy back their stock, pay a dividend, and everybody's happy. You say, well, give me an example. I'll give you an example. Look at General Electric over the last 10 years and look at IBM as well.
God, you're sour. She'll be back
I'm
tomorrow.
not sour. I'm not sour.
Those are companies. Those are dysfunctional companies on their own. I don't think that's.
Angry, though.
Well,
My
he
God,
is.
at the Fed.
I'm not angry. I'm happy as can be.